And welcome back, students who are taking financial accounting. And in this series of videos, we are working on the Chapter 3 problems, the Group B problems that were assigned in the digital study guide. And as always, if you're not understanding something, financial accounting is about understanding an application. So if you're not, applying what you understand, you're not getting the answers to these problems, and you watch the video, you rewind it, you watch it again, and you're still not understanding how to get the answer, then that's a problem with your understanding of the concept. So you'll need to go back and watch the theory videos again, at the beginnings of chapters 1, 2, and 3. And if you're still not getting it, then feel free to telephone and speak with an instructor. So let's move on to the first problem. All right, let me get my pen here. Pen, there we go. Okay, so problem 3-48 says journalize the adjusting entries needed at December 31st, the end of the current accounting year, for each of the following independent cases affecting Mountain Mania. No other adjusting entries have been made for the year. Right? So letter A here, it says prior to making the adjusting entry on December 31st, the balance in the prepaid insurance account is $1,200. Mountain Mania pays liability insurance each year on April 30th. Okay, so let's work through this problem. All right, so we have a prepaid insurance account, and it says prior to making the December 31st entry, the balance in the account is $1,200. Okay, that's debit. Prepaid insurance is an asset. We increase our assets on the debit side, so that's $1,200 on the asset side, and it is prepaid. Now we're making an adjusting entry for December 31st. Okay, and it says that it pays liability each year on April 30th. So if let's draw ourselves a timeline here. I'm going to just do it right here. All right. Okay, so this here is April 30th. And this is the end of the year, 12/31. Okay, so if it's prepaying each year on April 30th, that means it's prepaying the entire year all the way up to April 30th of the next year. Okay, so this here period is for this year, but they're paying for the entire year, this period. Right? So what portion out of this entire year has been used between April 30th and December 31st? Well, April, that's May 30, June, July, August, September, October, November, December. So that's 1, 2, 3, 4, 5, 6, 7, 8 periods. Okay. So if we have $1,200 and we know that we're using 8 out of the 12 periods, okay, we do the math, that's $100 a period times 8, which means we have an adjustment for $800. So since our since our prepaid insurance has a debit of $1,200, we're reducing that, which means we have to credit it. So I'm going to make a credit to prepaid insurance for $800, and we have to debit something else. Debits have to equal credit, so we have to debit something else. And obviously, since we're prepaying our insurance, if we looked at our expense accounts, we would see an insurance expense account, and we would debit the insurance expense for $800, and that's our entry for that particular adjustment. Okay. Erase all of this. Okay, next. So that's A. All right, B. Pays employees each Friday. The amount of the weekly payroll is $12,500 for a 5-day work week. December 31, the fiscal year end is on a Monday. Okay, so let's draw that timeline again. So this is December 31st, and this here is a Monday. Okay, so then we have Tuesday, Wednesday, Thursday, and Friday, right? Which ends up being in the next year. Remember, it's because this is 1-1, this is 1-2, 1-3, 1-4. Okay, this is Monday, this is Tuesday, Wednesday, Thursday, Friday. Okay, so if the payroll for the entire week is 12,500, and we're making an adjusting entry for the end of the year, and Monday falls within the end of the year. Okay, that means we have 5 days, and we have to include one out of those 5 days. So we have to take our 12,500, and we're going to multiply it by the 1 day, which is Monday, over the 5 days in the week, and then we do the math. So 5 into 12,500 goes $2,500 times 1, so we have 2,500. Okay, so that's going to be $2,500 per day, and since that is an expense to us for the day, because we're going to pay that payroll. We know that if we have our expense account, when we increase our expense account, we increase it on the debit side. So we're going to look at our expense accounts and see that we have a debit for salary expense, and that's for $2,500. Since debits have to equal credits, we credit something else. Well, what are we going to credit? Well, we're not paying Mondays until Friday. Okay, so it's something that we're going to owe on Friday. And if we owe something, that's a liability. And if we look at our liability accounts, we'll see a salary payable account. And so we credit salary payable for $2,500, and that's our entry for the payroll expense. Okay. All right, so we did A, we did B, C. Receives note receivable from customers for services provided. For the current year, accrued interest amounts to $640 and will be collected next year. Well, if we're receiving a note receivable and we're accruing interest, all right, that's going to be an interest receivable. And a receivable is an asset, and we increased our assets on the debit side, so simply we're going to debit interest receivable for the full 640, and since debits have to equal credits, we'll credit something else. Well, what are we going to credit? Well, just like when you're making a sale, okay, and you take on an accounts receivable, well, when you're dealing with interest receivable, you're going to have an interest revenue. And so we credit interest revenue for 640 because we're going to book that that interest as our revenue. Okay, so if you look under the revenue accounts, you'll see an interest revenue account. So we debit interest receivable and we credit an interest revenue. That one was relatively simple. No calculating there, just having to know what accounts that we have to deal with. The beginning balance of supplies was $1,025 during the year. 4,300 of supplies were purchased. At December 31st, the supplies on hand total was 2,500. Okay, so if we look at our T account, supplies, and it's telling us that at the beginning balance of supplies was $1,025. Well, supplies is an asset, and we increase our assets on the debit side, so our beginning balance is a debit for 1,025. Notice that I'm using the T accounts. Remember, T accounts are a tool to be used, okay? And I'm looking at specific situations. I mean, yes, I can use the T accounts for many different, for different things. I can use it, I'm looking at a specific ledger account here. And, I can use it to figure out what kind of journal entry to make. I can use it to represent the trial balance. The T account is basically just putting debits on the left and credits on the right. Whenever you're working with debits and credits, you can use the T account as a tool to visually see, what, to be able to figure out what you need to figure out. So it says here, during the year, $4,300 of supplies were purchased. Okay, well, if I'm buying more supplies, that means my supplies increase, and I increase my supplies on the debit side, right? Because supplies are an asset, we increase on assets on the debit side. Okay, so now it says, at December 31st, the supplies on hand were $2,500. In other words, they took a physical inventory and they said, oh, we have $2,500 on hand of supplies. Well, our ledger account, as of that date, shows $5,325, but that's not the balance in the account. The balance needs to be $2,500. So I'm going to have to credit the account because I'm going to reduce the balance from $5,325 down to $2,500. So I'm going to have to reduce it by crediting it, and so that means it's the difference between the two. So $5,325 less the $2,500 means my supplies expense account is 28. I'm sorry, the difference in the account is 28.25. So I'm going to want to credit the supplies account for 28.25, which would then give me the balance of 2,500 in the account, right? So I'm going to credit supplies for 2,500, and I need to put that somewhere. So debits have to equal credits. So I debit something, and of course, if I use the supplies, that's an expense to me. So I look at my expense accounts and I'll see a supplies expense account, and I debit supplies expense for 2,500. Okay, that was D. And E, during the year, received 17,200 in advance for services to be provided at a later date. Okay, so we're receiving money in advance for something that will perform the service later, right? Doesn't that, when you're receiving something for a service, that means it's unearned. Okay, you didn't earn those yet because you're receiving the money, but you didn't earn it yet until you actually provide the service. So as of December 31st, they earned 4,700 of the total fees received in advance during the current year. So if we have the account, and it's an unearned account, and this is for services, so unearned service revenue, right? Well, from our theory videos and the information in the text, we know unearned service revenue, it's something that we still owe because we haven't earned it, so that's a liability account. And we increase liability accounts on the credit side. Well, if we received $17,200 in advance, right? That means we would have credited the $17,200 to unearned service revenue. Now it's telling us that as of December 31st, we earned $4,700 of the total fees, right? So if we earn $4,700, that means we have to reduce the unearned by the 4,700. Well, if that was a credit, to reduce it, we would debit it. So I end up debiting unearned service revenue for the 4,700, and that debits have to equal credits, so I credit something else. And if, since I'm dealing with service revenue, I look at my revenue accounts and I credit my service revenue account for 4,700, because why? Well, I'm actually, that's, since I'm earning it, if I was being paid on a cash basis, I'm recording the sale. I would have recorded it as, service revenue. All right, and lastly, we have depreciation. Depreciation for the year includes vehicles for $2,550 and equipment for $1,300. Okay, now, this can be done two different ways. Okay, and I'm going to do it, by the way, in the solution manual. All right. So if we're depreciating an asset, we're expensing that. So it's as simple as debiting, because it's an expense account. Depreciation expense is an expense account. We're increasing it on the debit side, meaning if it was 0 before, and now we take the expense of $2,550 or $1,300, we're increasing that expense, so we're going to debit it. So I debit depreciation expense for vehicles for $2,550, and then I have to credit something else. Well, I have to associate that with the asset. All right, it's a contra account to the asset. So I'm going to credit accumulated depreciation vehicle for $2,550. I'm also going to do the same thing for the equipment. I'm going to debit depreciation expense equipment for $1,300, and I'm also going to credit the accumulated depreciation equipment for $1,300. Okay, so that's the solution in the textbook. Now, I am going, I'm going to leave these two entries here, but I'm going to write in basically a combined entry up here. And when I combine this entry, when you look at a set of books, not all of your expense accounts are going to be depreciation expense vehicles and depreciation expense equipment. Okay, generally you're just going to have one account called depreciation expense. All right, even though our accumulated depreciations have to have the name of the asset that they represent, that they're contra to. Okay, but on our expense side, we can just have one account called depreciation expense. We don't have to have depreciation expense vehicles and depreciation expense equipment, depreciation expense furniture. We don't. We could just have one depreciation expense account. And if we do, then what we can do is we can combine these entries together and make this a debit to depreciation expense vehicle for $2,550, a debit to depreciation expense equipment for $1,300, and then since debits have to equal credits, we add our two debits together and we credit just, oops, I'm sorry. Sorry about this. Did it wrong. Even I make mistakes. Okay, so we're going to debit depreciation expense since we only have the one account, but we don't know what that amount is just yet, right? Since debits have to equal credits, we have a credit to accumulated depreciation vehicle for $25.50 and a credit to accumulated depreciation equipment for $1,300. And since debits have to equal credits, right? Well, we add up our two credits, and that gives us $38.50. Okay, and so we would debit depreciation expense for $38.50. Okay, and so that would be, if I were in the workplace, if I were making the entries for depreciation, this is the entry that I would make right here. Okay, and for the simple reason we would only have one depreciation expense account. However, look at your chart of accounts, right? If my chart of accounts had separate depreciation expense vehicle account and separate depreciation expense equipment account, I would then make the entries like this. Okay, I would have to make the two entries. But if I have just this one depreciation expense account, I can make the entry like that. Right, so that's it for that particular problem. And if you don't understand something, reread the sections in the textbook and watch the theory videos. I realize that the sections in the textbook are a little bit sparse on instruction because it's they're trying to get through the material quickly. So the theory videos explain a little bit more. But with that said, this here is a problem, and it just went through 6 different common adjustments that you would find in the workplace. Okay, these are the more common ones, so use these as a template for your thought process in making your adjusting journal entries. And again, if you don't understand something after watching the theory videos, feel free to telephone and speak with an instructor. All right, see you in the next video for the next problem.